All righty, folks, we're going to have kind of a important conversation about taxes, tax surprises. Over the last couple of years, you probably undoubtedly heard about something called bonus depreciation. This is something that has been pushed by multifamily buyers, commercial buyers, big stuff, right? The ability to have a bonus depreciation year one, write it all off. But you know what? That's going to probably turn into some unpleasant tax surprises or potentially put you on a treadmill to a lifetime of 1031 exchanges. In order to have this conversation, we're bringing back the one and only Mr. Jonathan Twomley. How you doing, sir?
I'm great, Michael. Thank you so much.
So this is the world you live in. So let's tell everybody what bonus depreciation is first, and then we'll talk about the surprises coming.
So bonus depreciation is something that came in the one of Trump's tax reforms.
Tax cuts. Yep.
Tax Cuts and Jobs Act, I think it was called.
That was
the one.
So,
and basically the idea is that essentially you could accelerate all the depreciation for like a whole building into year one if you wanted to. And what a lot of people do, they're not that extreme with it, but they'll do what's called a cost segregation study, which is where they go and they have an expert come in and literally break the apartment building down into its component parts, and then depreciate everything according to the appropriate schedule. So the building itself depreciates at 27.5 years, but the cabinets, the carpets, the toilets, the bathtubs, the lights, fixtures, all of that stuff has a different depreciation schedule and usually much shorter, which means that something like, 40% of the building or so may be able to depreciate on this faster schedule. So, and that's not even bonus depreciation. That's just regular depreciation, cost segregation, right? So what happens is you get a big tax benefit, right, from doing this. And it's really early on in the deal, which is great. And this is sold all the time as a big reason why you should get into, multifamily investments as an LP. The thing that is not spoken about so loudly is, now listen, before I even get into this, I think that when you're getting this depreciation, it's knocking out most of your income. It's great. Like this is just such a tax advantage thing.
I have a cost segregation guy that I work with. I have personally done cost segregations. I happen to be, my income allows me to do that. So I have done these. It's not that I'm against them. I believe if they're out there and it fits your plan, it's amazing. So I've done them personally on my portfolio.
So you basically get nothing is tax free, but you get tax deferred income, right? As long as your depreciation is exceeding the amount of income coming off the property. And this could be great. This can be great for people who are, professionals who are taxed really heavily on their income. This is a chance to get some tax-free income, right? But what is often sold here is this idea that you're getting a tax loss, right, on your right. So the depreciation is, especially if you do cost segregation, right, because you're getting all this depreciation, that your depreciation is going to exceed the amount of income that you have from the property, and you're going to get this tax loss. Now, that's also a great thing to have if you can use it, right? If you can use it. And the thing is, unless there's only one way that most people can use it, and that is if you have other passive income that's taxable, then you can use it against that. Right? But you can't use it against your regular income. You can only use it against other passive income. Unless you are what's called a real estate professional.
Exactly.
Then you can use it against all of your income, right? So, but most people are not real estate professionals. They can't use this. So there's a little bit of a slightly misleading thing going on where people are being told that they're going to get these tax losses, right? But it's really, and it's true in a theoretical sense, but in their individual case, they may not actually be able to use them, right? But if they do use them, and even if they don't, even if they're just, if they can't use them, they're only just getting the regular depreciation, right? And it's eating up all the income. What happens when you sell, and this is why, when people say it's tax-free, it's really misleading because it's not tax-free, it's only tax-deferred. When you sell the asset, now there's what's called recapture, right? And what recapture is let's just try to make it super easy, right? Let's just say you buy a property for $1 million, right? And you've taken enough depreciation that by the time you sell it, right, you sell it for 1.5 million, and you've had, let's just say, pull a number out of the air, you've depreciated $250,000, right? So now you have $250,000 that you've taken depreciation losses on, or you've used it up against the income. You now owe recapture tax on that 250 plus the capital gains on the 500 profit, right? So it's not just, it's not, so people think, oh, I've got capital gains on the 500 profit, that's it. No, 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 no. You got the tax benefit in earlier years of using up that depreciation. Now you got to pay the government back. And
well, let's even make it more painful, Jonathan. I mean, let's say you were part of a multifamily purchase the last couple of years. You bought it for $5 million. You took bonus depreciation in year one, and you wrote off $1 million. Now you got to sell the building. You're going to sell it for what you paid for it. So you made no money on the purchase. In fact, you lost money with transaction costs. You're going to have $1 million in depreciation recapture. You're paying taxes.
Yes. So this is true. You will pay tax in that situation because you got the tax benefit before.
Exactly.
Right. Now, it's true that probably the recapture tax is a different rate. It might be at a lower rate than you whatever before. But the thing is now you've got a bill. You've got a tax
bill.
Yeah,
you're not excited though. You bought a building for 5, sold it for 5. You still got a tax bill. You're not excited about that.
Yeah, you've got a tax bill. And let's make it even worse. What happens if you did a cash out refi?
Oh,
right. And now you could be like actually underwater. I mean, there's just all kinds of terrible scenarios that can result from this, right? So what happens in that situation is that you're essentially forced into a 1031. Like the only way that you don't lose your shirt on this is that you 1031 and you defer the tax. But now what happens? See, a lot of people don't think this extra step. They're like, oh, great, I saved the tax, right?
Yep.
1031. But now you're accumulating tax on the second deal too, right?
Yeah.
So, and every time you do a 1031, you're accumulating a bigger and bigger recapture bill because every single property, you've got that old recapture stacking up and the new recapture, right? And so you wind up essentially on a 1031 treadmill. You have to hold, you can really never exit this deal. So you hold it until you die when then your heirs take the stepped up basis and it all gets wiped out, right? But if you ever need that cash for some reason, like you really can't sell, you're sort of stuck. And now this is fine. Like this works for institutions that are constantly doing deals, right? They're always bringing in new deals. There's always something to offset, or wealthy people, really wealthy people that have all kinds of passive investments. And there's always things to use to offset the income. They could do a new deal. They can harvest tax losses. Like they can do all these things. But for the average person, this is all way too complicated and doesn't really work, right? So, I mean, I know I've talked with accountants who will say, well, we can do something to help you offset the tax, but what they really mean is like, go buy something else and take more bonus depreciation, right?
Do it again, more is better.
Do it again, right? So you're basically getting deeper and deeper and deeper into this. So it's not always the best, and you really have to think about this in your individual situation. Is it really the best option for you long-term to roll it over into a 1031 or to just take your lumps, pay the tax and take your lumps now and have the cash?
There's so many LPs who got caught up in this whirlwind of easy money, bonus depreciation. It's just, it's time to pay the piper.
It's all about the greed, Michael. It's the greed.
I know, exactly. It's the greed. Yeah. So again, folks, there's a lot of pain coming, but again, if you've been preparing, you're getting ready, getting educated, you got a buy box, you're looking, it's going to be amazing. I know Jonathan's excited for what's coming. I'm excited, but both of us got prepared for this and we both have been through a cycle before. If this is your first time, realize where there's crisis, there's opportunity. Again, I would tell you to go back and read Sam Zell's book, Rest in Peace, Sam Zell. He made his name. He became a billionaire because of the S&L crisis in the 80s, RTC. Go ahead and research that. There's a lot of opportunity coming, but we do got to, there's some people that are going to pay a pretty steep price for being greedy. So Jonathan, where can people find you?
Yeah, please come join my Facebook group at apartmentinvestorsclub.com. If you're in the group, you can always message me and ask me questions. I mean, people don't take advantage of it enough. You can tag me, ask whatever question you like. You can get on my email list by going to apartmentinvestorsclub.com and getting my free download, or if you'd like to invest with me, Google Two Bridges Asset Management LLC, and you can find our investor page and register there.
Awesome. Thank you so much, Jonathan. It's amazing.
Thank you.
Mhm.